Hello, I'm Marianne Deveni. The S&P TSX Composite Index is up almost 14% over the last year, but the preferred index is actually in the red. Now, why is this? What has happened to preferred shares? They were once the market darling of dividend investors. Well, I'm joined today by Scott Booth, who's Senior Analyst, Portfolio Advice and Investment Research at TD Wealth. Good to see you again, Scott.
Thank you very much for having me on.
So what's been happening in the preferred share market? We've seen a big drop. What's going on?
Well, certainly there has been some pretty marked underperformance on a relative basis compared to the TSX. Preferred share market's probably down a little in excess of 5.5% year to date in Canada. There's been a couple factors that have really contributed to that. I think number one, and probably the most visible one, has been the increase in interest rates. Now, when the Federal Reserve started talking about tapering their asset purchases back in May or whenever it was, saw interest rates start to march higher. And preferred shares are an interest-sensitive asset, so as interest rates rose higher, the prices of preferred shares fell. So rising interest rates, number one. And then I guess the second thing that we've noticed that probably doesn't get as much attention is there's been a bit of a repricing of extension risk associated with a lot of the rate reset preferred shares that are out there. Those make up a very good portion of the market, and of the issues that have come up for reset or redemption this year, a good percentage of them have had their dividends reset, and they've had their dividends reset markedly lower. So you've had stuff, drop from paying 5.25% a year down to 3.4% a year. And so for investors, I think that's been a bit of come as a bit of a shock for one thing, and led them to kind of reevaluate their holdings. So I think that's also been a factor too, is just that kind of repricing of risks and the potential for the dividends on these things to change.
So let's take a little step back then. What do you consider preferred shares? Are they fixed income, or are they stock, both?
That's a tough question. They're a bit of a hybrid. I mean, from a technical perspective, absolutely, they're equity. There's no doubt about that. But certainly when you look at how they perform in the marketplace, you find a lot of similarities and kind of correlation with how fixed income instruments perform. They provide a fixed cash flow for the most part, and if interest rates change, much like a bond would, they'll fluctuate in prices. If interest rates rise, the price of a preferred share is going to fall. If interest rates fall, the opposite's true, prices are going to go up. So in that sense, I think there are some attributes that are very similar to fixed income. One difference would be that if you buy a bond, it's got an end date on X day in the future, you're going to get your principal returned to you, and there's certainly no guarantee of that in the preferred share market. You're agreeing to lend a company money forever in exchange for a certain cash flow that's going to generate for you. So that's one key difference there. The other thing, I guess, relative to bonds is that preferred shares pay you dividends. So that you do get the benefit of the dividend tax credit associated with them. And so that preferential treatment of the income stream that they provide is a key differentiator in the space. Now, when you look at them relative to common shares, you probably got a lot of more upside potential associated with them. You're not going to get that with a preferred share. What you will get is a priority of the dividends that are paid. If a company wants to pay a dividend to their common shareholders, they have to pay their preferred shareholders first. So that added degree of certainty about receiving your dividend is a key differentiator between those two there.
Now, you mentioned a number of different types of preferred shares. How many are there?
Oh, there's quite a few. I'll rhyme off a couple. There's retractable issues, there's rate reset issues, there's perpetual issues, there's floating rate issues, there's fixed to floating issues. So there is a wide variety that'll all get you a little different exposures to different parts of the yield curve, and have varying degrees of interest rate sensitivity and risk. So I'd say the most popular or certainly the types of issues that make up the majority of the index are rate reset preferred shares and perpetual preferred shares. Now, perpetual preferred shares are probably what most investors think of when they hear the word preferred share. It's something that's going to pay you a fixed dividend for as long as outstanding, which could be forever, hence the name perpetual. So if it pays you $1 today, it's going to continue to pay you $1 forever, and that's just how those work. Now, The downside with those is that they're sensitive to rising interest rates or sensitive to interest rates in general. If interest rates increase in the market, then that cash flow that you're getting isn't going to look as appealing and the price of that instrument is going to fall. Now, one of the recent innovations in the pref market is the rate reset preferred share, and I think that's come into being to kind of offset that, or at least kind of avoid some of that risk. So the rate reset preferred shares, they have a mechanism whereby the dividend and the cash flows on them reset every 5 years. This provides investors with a little bit of hedge against rising interest rates. You're not so concerned about that, and it serves to reduce the sensitivity of rate reset preferred shares, particularly compared to perpetuals. So that reset mechanism is something that's found a lot of appeal for investors. If you look at the growth in that segment of the market, it's certainly, I mean, it's exploded and certainly is now the dominant form of issuance in the marketplace. And I think it for a lot of investors find that structure appealing.
So as interest rates increase, then there's a mechanism, and it's actually all laid out, the terms by which it will increase. Is that how?
Exactly. So at the time of issue, let's say that company A comes to market with a rate reset preferred share that yields 5%. If at that time Bank of Canada bond yield, the 5-year Bank of Canada bond yield is 2%, that issue is going to have a reset spread of 300 basis points. And so that's fixed, that's written in the prospectus, and then that security will pay that 5% dividend for the first 5 years, and then on that reset date, the dividend will reset. If the issue isn't called, the dividend on it will reset at whatever the prevailing Bank of Canada 5-year rate is, plus that reset spread that was indicated in the prospectus. And so that mechanism there provides investors with that, that reduces that sensitivity to rising interest rates. Investors also have the option to exchange their holdings for something that's reset quarterly and floats off the Government of Canada 90-day T-bill plus that reset spread. So there's some optionality associated with those as well, and it's certainly a feature that we find appealing, and obviously with the popularity of that type of structure, investors do too.
And you brought a couple of examples. Let's start with the first one.
The first one I thought of, I guess I'd view through the lens as something that could be used to supplement the income stream from a fixed income portfolio. It's a higher quality name issued by Enbridge. It's got a P2 low rating, so it's in the investment grade realm. It pays $1 a year in terms of a dividend. It's trading at a small discount to its par value at around $24.50. It's currently trading to yield about 4.4%, assuming it gets called away in June of 2018. Now, if it doesn't get called away, the dividend will reset, like I said, at the Bank of Canada 5-year rate plus that reset spread of plus 251 basis points. Now, we think this looks appealing relative to Enbridge's common. If you look at that, I think I looked earlier this morning, it was trading to yield about 2.93%. And if you look at their debt, I was looking at an issue that came due in 2019, and it's trading to yield about 3%. So if you're getting, a dividend in the kind of 4.4% range, particularly when you factor in the impact of the dividend tax credit and the fact that they do receive favorable tax treatment, then I think that looks pretty appealing on a relative basis.
And you would expect a utility to stay around for a while.
That's what we're looking at. Yes.
All right. And you have another one.
I do. So one of the parts of the market that's really come under pressure in the rate reset space is the utilities, and particularly a lot of the sub-investment grade issues. So we'd probably not be looking at this issue as a way to supplement the income of a fixed income portfolio. We'd kind of view it as an equity alternative, I guess, at this point, and typically, for a lot of the sub-investment grade issues, that's the kind of lens we look through this stuff at. TransAlta H's, ticker TA.H. Now these pay a dividend of $1.25 a year. They have a par value of $25, and they're currently trading at a pretty substantial discount to that. When I looked this morning, they were trading at $21.50. So there is some upside potential on these, we think. It's an issue that comes up for reset or redemption in September of 2017. If it gets called away, it'll yield you north of 9% to call, 4 years out. If it doesn't get called away, the dividend on will reset at whatever the prevailing Bank of Canada 5-year rate is, plus 365 basis points, which we think is fair for that credit. They recently came to market with some 7-year debt that's trading to yield a little south of 5%. So we think relative to that, these look fairly appealing. I think the common yields north of 8, but a little different risk profile associated with the preferred shares relative to the common. And as I alluded to before, for any issuer that has common shares outstanding, if they want to pay a dividend to the common, they have to pay the preferred shareholders first. And with that in mind, we think this is an investment that we're pretty comfortable with.
So there's always a bit of risk in everything, but this is definitely a little less risky, you would say, than common stock?
I would say, yeah.
All right. Thank you very much, Scott.
Thanks for having me.
I've been joined by Scott Booth, who's Senior Analyst, Portfolio Advice and Investment Research at TD Wealth. Thanks for watching. Join us again next time. Before you decide to invest, make sure you do your homework and ensure that the investment is aligned to who you are as an investor, including your asset allocation and your tolerance for risk.